Welcome to the Daily Update. This is Being Prepared Friday, July 11th, where we'll look at the action in the market today and then see how things look for Monday, July 13th. And it was a little bit of a down day. So some of our indicators that attribute everything either up or down, they switched a little bit. And I'll try to point that out as we go through the charts, but we're still looking positive overall. We had the employment situation report come out, and that was actually stronger than expected. And that freaked out the markets a little bit for a little while, because we have all these things suggesting that we might be going into a recession, but employment is hanging in there. And that's usually not the way it works. Usually employment starts to evaporate or go away or decline, and then we head into a recession, or it starts to decline while we're in the recession. So the fact that the employment report was stronger than expected just kind of went, oh, wait a minute. Now the Fed's going to have to keep raising interest rates. Oh my, we're still in this hawkish environment. So let's go back and talk about the day. We did have a gap lower open to S1, which was at 38.71. Prices rebounded to almost R1. So we saw a pretty healthy bounce back up at 39.23. As the day went on, we saw pretty much a choppy day. It was like a roller coaster or a wave. And we chopped down below the daily pivot at 38.91. Then late day buying, or later in the day buying, took prices back positive. So that was looking pretty good. But then we saw some selling going into the close. So we ended up being down 0.08%. Volume was below average. And the technicals are, yes, they're starting to turn more positive right now, and they're still holding up. There's a little bit of weakness after Friday's session. We're still trying to figure out, can this continue? Can these positive things that we're seeing under the surface, can that eventually come through to a significant price advance? Of course, we have inflation, interest rates, and growth concerns as the real headwinds right now. The geopolitical concerns, and my goodness, I guess the former Prime Minister of Japan was assassinated on Friday. That's really crazy. Earnings, it's kind of light right now, but they're going to be picking up again here in the next few weeks. And then recession fears. And that's the big thing that people are debating about right now. So what are some comments? We can still say that the rotation scenario is holding up. The charts actually improved a little bit on Friday. The S&P is slightly below 3,900, which again is more of a psychological level. The NASDAQ was up. And that's kind of what we're watching now. That's the real growth area. And if we're going to get a real move upward, we want the NASDAQ and the NASDAQ 100 to really lead the way, so to speak. There are a lot of NASDAQ 100 stocks specifically in the S&P 500. So if they really start to go higher, that could also help the S&P. Oil continues to climb. After dropping below 100, it's inching its way back up. And this should not be here. Copper and tech. The 10 to the 2 and the 10 to the 5, they're still inverted. And fear is still extreme, or still really fearful, but not as extreme as it was. We had the employment report, and I'll go over that in the next slide. We had wholesale inventories. They were up 1.8%, and consumer credit was at 22.3. That was really a decline, actually. And our trend is still negative. The ADX is falling. It's still slightly above 20. If we have another day like we had on Friday or two, you probably will see the ADX drop below 20. Our bias, I'm still keeping it mixed right now. And our momentum is mixed. You could almost put it a slant more towards positive. We were up on the week, but I'm still keeping it mixed to negative because of all these headwinds that we have right now. So here's the employment report. We came in at 372,000. They expected 250,000. So that was a much stronger than expected. We had the private payrolls. They came in at 381,000. They expected 275. So this was, again, stronger. The average hourly earnings, and that's what the market really looks at for inflation or the different pressures in the economy. It came in as expected at 0.3%. The unemployment rate, which pretty much nobody pays attention to except politicians, it stayed at 3.6%. They monkey around with this number so much, it's really not all that useful, except as a talking point. And the average work week was 34 34.5. They expected it to be 34.6. So I guess people got a tenth of a day off more than they expected. So let's go back and first look at sentiment. We're at 30 right now. We're still fearful, but not extreme. And here is the historical chart to show how that has trying to come bouncing up after being extreme. We did get the latest reading with the Ridex bear bull ratio. Just shows people are really dumping more into bearish funds right now. Not necessarily a spike, but not necessarily what we're seeing right now, unless you're coming to a real bearish conclusion. Then this chart just shows the average S&P return before and during bear markets. Just shows up here in the top where this is the return that we've been seeing. And then here's the average return before and during bear markets down on the bottom. It's just showing that, yeah, we've had some problems, whether we're in a recession or not in a recession. And here is the recession. Right here is the dark green line. And then down here is showing the recession. And this dotted line is when there's no recession. Of course, we end up doing better, even if we go into a bear market. Also, we have the buybacks, the corporates, they call that. They're still declining. The 4-week average is declining overall. We can see it coming down slightly over on the right-hand side. This just shows the initial jobless claims going back and looking at other years and how have we fared. It's been a lot lower, that's the dark blue line, than other years. But right about now is when we start to see a spike in jobless claims. Are we going to see that again this time as well? And then it tends to calm back down and then kind of gets back more to the average. Then we had the NAAIM number come out. They're at 27.85, still pretty extreme negative and actually declined a little bit, but they had gone down to actually below 20 just a few weeks ago. And then we had the latest update from the Real GDP Nowcast. That's the St. Louis one, and that's showing us with a positive GDP. We also had an update from GDP Now. That comes out from the Atlanta Fed, and they're suggesting that we will have a decline. All right, then we also have the same bear bull ratio here. Let's look at the VIX, where it did decline. Even though we had a down close, it was positive for a lot of the day, especially later in the day. So we saw a decline with the line chart, and we really dropped lower on the bar chart. And here's the VIX of the VIX, which is also continuing to decline. It's just showing the volatility is really slowing down right now. The Ulcer Index is also suggesting that there's no fear or very little fear in the market. We're down 19.08% from the all-time high. The equity put call ratio for 1 day did decline, and for 5 days is also declining. And then I have the other chart that I'll show here in just a moment. Here are the support and resistance levels for Monday on the 10-minute intraday chart. And here's the daily chart showing that we're still above the pivot. That's still positive. Can we keep going up from here? And you can see where volume really, really dropped off on Friday. Got the dog days of summer. We're still above this support on our machine gun chart, but we still have resistance overhead of where we're at. And this is showing pretty much the same thing. I just tried to clean it up a little bit, where we do have some resistance, but we're also above support right now. Here are the monthly pivot points over here on the right-hand side with all the numbers up here in the left-hand corner. Here's the Fibonacci retracement, just showing that we're still above this 38.2 and 61.8% retracement that we saw. And that's positive. That could be pretty significant support because it was pretty significant resistance. And now that we have broken through that, that could be positive. And here's the weekly chart showing that we're still above this 38.2% retracement. Our sectors, we had material, since we were down, I organized this by what was down. Materials were down the most in communication, real estate. There were 3 sectors that were up: discretionary, tech, and healthcare, but ever so slightly. Just was not much of a day. Here is the Scooter rating showing that energy, healthcare, and utilities, as well as staples, are giving us into the 90s here. And the weakest charts are materials, discretionary, and communication. And then here is the sectors showing that energy has still been doing the best. Utilities are slightly positive. The rest of the sectors are negative. Here are the indexes, and I'll point out the right one this time. The pink area, that's the S&P. It just shows how we have been down since the all-time high. The technical alerts, most of them were negative because we really shot lower. So that triggered an SPX indication that we dropped below 3,900. The rest of these were not related to the S&P, but then the dollar came off of its high, but it did set another 4-year high. It's just screaming higher. Then I finally was able to remember to get the overnight futures and the times at the bottom will be different than what you are. But this is how the futures were looking. We were slightly positive, then we dropped down to slightly negative. This dash line is the unchanged level. And then we looked like we were starting to come up more positive, and then the report came out, and then we dipped down. Then we reacted to that more positively, and then here is the open that we saw with the stock market. So we gapped lower all the way down to S1. We bounced back up, went positive, almost got up to R1, came back down, went negative again, danced around the daily pivot for a while, went back positive, kind of almost retested the high, and then came down off of that slightly. So we were down just slightly on the day. Our trend continues to fall, and we're at 20.25 right now with the ADX. But we're still in a trend technically. The advanced decline showed a little bit of a decline based on price and volume. We're still slightly positive with the advanced decline ratio. The new highs, new lows, this is pretty critical. They're still hanging in there and showing that we're going in the right direction. Accumulation distribution is also showing improvement. The decision point actually changed their scorecard. The trend model switched to positive in the short term after Friday's session, where the PMO has been positive for a couple of weeks now, actually a week or so. We're still above the 20-period moving average, both the simple and the exponential. Here's our moving average tree. We have a long way to go to get back up to some of these moving averages. We're coming up into the underside of the short-term rainbow with the 10 and the 20-period moving averages. And the Stochk RSI is now pegged positive and declining. Williams percent R turned down a little bit, but is also extreme positive. These are pretty touchy though. The force index declined very slightly. The Swinland trading oscillator, it's still hanging in there. It's positive based on price and volume. The McClellan oscillator is still above zero, so that's positive, even though it did decline. And we saw a little bit of a tick down with the 20, 50, and 200 period moving averages. The Stochk RSI is rolling over a little bit since we had a down day. The intermediate term is still strong, where the long term is turning back more positive. And then we're still above this anchored moving average, which could also act as pretty significant support. The PMO is positive, as well as based on price and volume. And the PMO study ticking down a little bit with the down day, with those PMOs that are rising. The buy signals are still going up, and the number of PMOs above zero, or the percent above zero, is still positive. The Chaikin oscillator is still positive, but rolled over slightly. Chaikin money flow, not doing, well, actually it showed a little bit of an improvement. I mean, we have a strong up day and this thing goes down. We have a little bit of a down day and this thing goes up. Yeah. Volume is really trailing off. The vortex is still positive. The summation index is positive based on price and volume. All of our oscillators continue to be positive. The BPI ticked up slightly, and it's coming out of giving us an extreme negative reading. Ease of movement was a little bit higher. Ultimate oscillator also going up, getting near extreme positive territory. TTM squeeze still showing improvement. Our different charts, I just have a couple. The Heiken Ashi drew in a new bar, and that's positive. And the Kagi remains positive. Our trading systems, the Elder remains positive with the SPX and the SPY. The SAR continues to be positive since the dots are underneath. Our go, no go system remains in a pale purple state. That's purple with a negative slant. Long term saw a little bit of a tick up actually with the 50, 150, and 200. And our special K is trying to turn back up a little bit there. The Dow is still above the pivot level, and that's what we're watching for right now. And the diamonds continue to be positive. The Qs are also positive. And here's the NASDAQ 100. It's coming up to the moving average. That might act as resistance. Can it break through this 50-period moving average? And the Vixen continues to fall, both on the bar chart and on the line chart. So fear is really coming out of the market right now. The NASDAQ is also dealing with its 50-period moving average. The dollar was down slightly, 0.13%, but is still in a really strong uptrend these days. And the dollar to the S&P is pretty much neutral with a slight going in the same direction bias. Oil went back up to 104.79, and oil and the S&P are pretty much neutral. Can't really get anything from their correlation right now. And the S&P and the 10-year, can you believe that? You got stocks and interest rates going slightly in the same direction. And the tech to the 10-year, same thing. They're both going in the same direction. Basically, we have two yield curves. We have the 10 to the 5 that's still inverted and the 10 to the 2. I tried to put a label on here this time. This is the one that most people watch, the 10 to the 2-year yield. The 30-year yield is still above this 50% retracement level, which may act as support if we start coming down. And here just shows how the interest rates went up. And we've got all these lines really close to each other. And that's what happens in this kind of an environment when we're really worried about a recession. The lines get all jumbled up. And then I have the intermarket analysis showing that our oil had really fallen down, but showed some rebound. The dollar is the next best thing going on because gold has switched negative since the beginning of the year, where we have stocks and bonds still negative on the year. Here's our scenarios. This is a new one, or one that I haven't shown in a while. This takes the highs and lows across the Amex, NASDAQ, and NYSE, and then takes a 5-period moving average of those. And when we have an extreme negative reading, sometimes that can mark a bottom in the market. Well, we came down, we had one extreme reading, then we had another extreme reading, and we're coming up off of that right now. And here is the 10-day average of the highs and lows. After giving an extreme reading, we're bouncing back up. Those that are above the 200-day simple moving average after almost getting extreme continue to bounce up. Here are those above their 50-period moving average, extreme negative bouncing. And the same with the mid caps and the small caps. So we're seeing some confirmation in this. This is the other VIX chart showing that we spiked up and are coming back down to be expected in a more positive environment. But a lot of times when we did spike up, that marked a significant low in the S&P. The Copic curve is still generating a signal. The Pring bottom fisher is also still generating a signal, and that is directional, so it could go up. Our rotation scenarios are still showing improvement with the Qs outperforming the S&P, discretionary, they're above, and the large cap growth over value. Growth is outperforming value. Here's some other growth value charts with the large cap advancing, mid cap advancing, and small caps advancing. So this scenario is still holding up. And then here's the 2-year treasury yield. We did fall back down from this spike. Is that going to mark some kind of an intermediate or short-term low in the S&P? And then the correlation between the S&P and the 2-year yield, they're kind of going in the same direction again. And the staples, we're starting to see a bit of a breakdown here. After being in a solid uptrend for the last few years since the COVID lows, we could be seeing a death cross in the near future here. And this is still looking more viable. It looks like we spiked up here and are coming back down. And so this has also marked a significant low in the S&P. Are we going to see follow through with price? So here's our outlook then. The technicals, yeah, they're turning positive. Sentiment is still pretty negative, which could work to our advantage. We don't have any economic reports coming out on Monday. We've got a whole list, and just pause this and read through it. Japan, I've been talking about that, but for other reasons. And then Japan was really in the news for their prime minister being assassinated, or former prime minister. And then the recession fears are kind of the real biggie right now. Our scenarios, yeah, we could go down for all of these reasons. but our technicals are starting to turn positive. We still have yellow, kind of a cautionary up stance right now, with the technicals turning more positive and a real disbelief that the market won't go up. Our scenarios are looking more positive, and our sector rotation is also looking more positive. The technicals are looking a little better. We're still above the 20-period moving average, and all the other areas that we might use as support or resistance, we're barely not neutral right now. Now, if we drop below 20, I will change this. But until we do that, we're not in a neutral market. So our conclusion then is that it's turning positive, but can it stick? We need to see more follow through than what we've seen. Short term is negative, but could be turning positive, as well as intermediate term, and long term, we are still negative. So thank you. Have a wonderful weekend. I'll prepare the weekly video over the weekend and the intermarket analysis video as well.